Hey, welcome to my channel where we talk about real estate investment from geeky perspective. We're talking about the finances of real estate, strategy, some of the areas that are not really sexy to talk about, but we'll talk about them anyway because that gives you more information to go and invest in real estate. Today, we're going to talk about cap rate. I know all of us heard about cap rate a lot. It's very scary. A lot of people don't know about it. A lot of people do know about it, but don't know how to use it. Maybe you're a new investor. You want to learn more about real estate finance. You want to learn more about some of the metrics. You want to be more confident. You want to have an idea of what are you talking about. Or you're a realtor. You're a realtor who's been really great, a lot of experience. Shout out to all of you who are interested in moving on to commercial or investment space and want to learn more about some of these finance words and some of these scary things that they talk about in real estate finance world. So hopefully this video can give you some information, some help, and give you some confidence to know exactly what some of the ins and outs of cap rate and some of these other measures are. So when you speak to your clients, you'll have a better idea of how to do it. Don't let things like cap rate or cash on cash or some of those big scary terms scare you. They're very simple, and I'm here to explain it to you. So what is a cap rate really? Cap rate is a very simple ratio, just like any other finance ratio. All you do is take your NOI, which is net operating income, and divide it by your value. There you go. That's your cap rate formula. But we know that we want to go deeper into this, understand what's the use case for it, what are some of the components for it. So let's go a little bit deeper. NOI. Well, what is NOI? Net operating income. Okay, but how do we calculate that? Well, it's very simple. When you look at a property, the property comes in with revenue that it generates, which is mostly rental income. So you take the annual revenue that it generates, you deduct operating expenses, which is every cost and expense that is needed to pay to run the property. Expenses that are for operations of the property, operations expense. And what you get is NOI, or net operating income. Obviously, NOI is different than NI, which is net income, or even cash flow. There's some other expenses for every property that is not operating expense. For example, accounting, bookkeeping, most important of all, mortgage. These are not operating expenses because you don't necessarily need a mortgage to operate the property. You don't have to pay mortgage. If you're a cash buyer, if you don't have any liabilities, you don't have to pay for those liabilities. So be careful when it comes to operating expense. You want to only take the expense that you need to run the property. Other expense types that we just discussed may not be operating expense. And I know it gets hard because in real estate, the state of reporting and financial reporting, the financial data that provides you as a potential buyer is unfortunately not that good. We all know about it. So sometimes you have to do a lot of digging, a lot of independent work to figure things out. It's not like you're going to get a perfect P&L statement, profit and loss statement that outlines everything. Me, myself, when I ask for financial information about a property, sometimes I just get a sheet of paper with handwritten numbers on it and I have to figure things out myself. So that's why I'm talking about it, because sometimes things can get a little blurry, things can get a little tricky. So to calculate net operating income, take the annualized revenue, deduct operating expense, and there you go. That's your NOI. Very simple. Now, calculating NOI is very important because you want to know that in order to run a specific property, what are the expenses of it relative to its revenue and how much money is left over for you. That's very important. And NOIs happen to be a part of the cap rate formula. So now that we understand cap rate very well, let's talk about something else, which is value. Value is very tricky. It's simply that value depends on your perspective. Value could be the listing price for a property or price that a appraiser appraised it as. Ultimately, when you buy the property, that'll be your value. It'll be the purchase price. Obviously, before you purchase a property, you can play around with the value a bit. You can put in the listing price. If the listing price doesn't work for you, you can maybe play around with the numbers, put in the price that you want to put the offer as. So you have some flexibility with the value on that to get the cap rate that you like. Ultimately, when you purchase the property, you have to always have the price that you paid for the property as the value as you're going on with your cap rate. So now we have the cap rate and you have the ratio. So the question is, well, what's the point of it? What's the point of cap rate? I mean, I heard people who know it are very cool. People who don't know it are not very cool. Are you a savvy investor just by knowing the formula? No, there's a lot of use for this cap rate. I think actually this ratio has a lot of utilization. I'll give you a couple of examples and you can use them as you see fit. The two main methods that I like to use is benchmarking and comparison. What is benchmarking? Benchmarking is that you can look at a property's cap rate and compare it to the comparable properties with the same characteristics. So if you want to buy a triplex that are each unit is 2 bedroom, 2 bathroom, has a cap rate of 6%, you want to compare that to the similar properties in the area and to see how their cap rate is. And I know it's hard to get those information, especially if you're an investor. I do that a lot. I go around, ask for financial statements for the properties I'm interested in, and create a database, very anonymous database. And again, if you want to reference the data, you can look at that to see, hey, triplexes in this area with this characteristic are, their average cap rate is around maybe 8%. This property is at 4%. So it's lower cap rate. It could be for either the pricing or for its NOI, but it is a lower cap rate. Therefore, it might not be as an attractive investment as you thought it would be compared to its comparable properties. Another really good method for using cap rate is comparison. If you have two properties that have the similar characteristics, let's say two triplexes with everything else being similar, you want to see which one has a higher cap rate, meaning which one has a higher NOI relative to its pricing. Let's say property A has a cap rate of 8%, property B has a cap rate of 5%. Obviously, property A has a higher cap rate, meaning its NOI to value ratio is higher. That might be a more attractive investment as well. One huge consideration for cap rate is that cap rate is just a piece of the puzzle. There are different pieces to it, and as an investor, when you want to go and invest in real estate, you have to consider different factors. For example, cap rate is just deals with a property. Remember we said about property as a self-sustaining business? Well, cap rate deals with that. It evaluates the property alone. Cap rate says, how much revenue does this property produce? What are the expenses to run the property? And what's the relativity of its net operating income to its value? It doesn't consider a lot of different things. For example, if you're an investor who wants to only focus on cash flow, in this example, you're a cash flow investor, you say, I don't care what the market is. I don't care about the price levels. All I want is I want to invest in a property that nets me a $12,000 positive cash flow annual. So when the year is done, after all is said and done, after you paid all your expenses, paid your mortgage, paid your accounting fees, everything, and you have a positive cash flow of 12,000, that is satisfactory. You achieved your goal. So cap rate is not as prevalent as something like cash on cash or annual cash flow. So you want to focus on those metrics more. However, cap rate is always correlates with things like cash flow, even is part of some of the bigger formulas that we'll look into later, like IRR, meaning if a property has a very low cap rate, chances are the cash flow is low too. Think about it. If your NOI is very low, your margins are very thin, and you want to finance to purchase this property, essentially what you have is a very thin margin. And if you add mortgage, accounting fees, all the other fees, administrative fees to it, suddenly you have a negative cash flow. So think of cap rate as just a very useful tool in your toolbox as you're starting your investing journey. We'll talk about more ratios like cash on cash. We'll talk about IRR, which is very cool these days. Many people talk about it. And we'll talk about more ratios, strategy discussions, or market discussions. But cap rate is a very useful tool. It's very ancient in real estate. So a lot of old school investors use it. A lot of folks feel like cap rate is the only measure they can go by. So cap rate is a useful tool to have. Obviously, we want to learn about other measures, other metrics, but have that tool in your toolbox, because as you're building your toolbox, you always feel yourself going back to cap rate, because cap rate deals with a lot of fundamentals of real estate. So keep in mind of that. So before I go, I want to talk about how this is useful to real estate agents and brokers. Love you all. I know you work really hard, and sometimes you might get investors who are interested in investing in real estate, either individuals, private equity, foreign investors, who will be asking about these things. They will ask about cap rate. They will ask about these measures. So hopefully this video helps you understand some of the specifics of it. And the way it works out for you is that if you have a client who's interested in investing, obviously you're the market expert. You're the person who knows the local market well. You can help them get the best investment. But sometimes they come at you with questions like, what is the cap rate for this place? Cap rate, or what's the cash on cash? I want to calculate my annual cash flow. Sometimes they can do it themselves, but if they ask you a question, by knowing things like cap rate, by knowing things like cash on cash, you build a little bit of credibility with them. They trust you now that beyond just being a local market leader or a local market expert, you understand the finances of real estate. So don't let words like cap rate, cash on cash, all these big scary words scare you. They're very simple, them throwing these ratios and words at you doesn't mean anything, because you know them, you can speak to them, you can measure them, you can compare them, and you can help them choose a better property based on them. So it's actually a good thing for you to know as a realtor as well, as you're speaking to these investment clients, to not only have a better idea of some of these specific, maybe more technical financial terms, but also just build credibility with our clients because they get to trust us more and hopefully choose you. Well, thank you so much for watching this video. I had a lot of fun doing it. Hopefully in the future, we'll talk about more ratios like cash on cash, cash flow, IRR, which seems to be very cool these days, investment strategy, state of our market, and finding ways to invest in real estate. Even though the market is very hot, maybe there's a higher barrier to entry. If you're new to real estate, you don't have much experience or capital, how to get into it by working in industries that serve real estate. So more of those to come. And until then, take care.